The digital world is ever-changing. With more than 20 years of experience in serving the investing public and the financial services industry, Cybercode has been providing financial training and information technology solutions for established clients. Cybercode is based in Singapore with 7 offices around the globe and continually expanding. Being ISO 27001 certified and having a proven reputation for service excellence, Cybercode endeavors to build long-term relationships with customers and business partners alike. Our services include, but not limited to, the following: investing public, to provide training programs to the public, such as investment and stock trading courses. Financial professionals, providing up-to-date training courses for the finance professionals, keeping them well informed with compliance, regulatory requirements, financial products, and best practices. Financial technology. We develop and provide information technology solutions and management services curated specifically for our clients' needs. Cybersecurity and data. We provide data, information, analytics, and cybersecurity services to your business, keeping your data safe. Since our inception, we have trained thousands of participants among the investing public, financial professionals, hundreds of B2B clients, and have continued to forge strong business partners. To find out more about what we do and how we can help you, contact us today. Cybercode is a leading financial training provider and a leading developer of information technology solutions and management services. The digital world is ever-changing. With more than 20 years of experience in serving the investing public and the financial services industry, Cybercode has been providing financial training and information technology solutions for established clients. Cybercode is based in Singapore with 7 offices around the globe and continually expanding. Being ISO 27001 certified and having a proven reputation for service excellence, Cybercode endeavors to build long-term relationships with customers and business partners alike. Our services include, but not limited to, the following: investing public, to provide training programs to the public, such as investment and stock trading courses. Financial professionals, providing up-to-date training courses for the finance professionals, keeping them well informed with compliance, regulatory requirements, financial products, and best practices. Financial technology. We develop and provide information technology solutions and management services curated specifically for our clients' needs. Cybersecurity and data. We provide data, information, analytics, and cybersecurity services to your business, keeping your data safe. Since our inception, we have trained thousands of participants among the investing public, financial professionals, hundreds of B2B clients, and have continued to forge strong business partners. To find out more about what we do and how we can help you, contact us today. Cybercode is a leading financial training provider and a leading developer of information technology solutions and management services.
The Institute of Banking and Finance, or IBF, was established to foster and develop the professional competencies of the financial sector. IBF is dedicated to empowering practitioners with capabilities to support the growth of the Asian financial industry. It is the national accreditation and certification agency for financial sector competency. Developed by the industry for the industry, IBF Standards is a set of competency standards benchmarked to international best practices. IBF's vision is to be the Asian standard of excellence for practitioners in finance. IBF Standards covers 13 industry segments and offers a wide range of development roadmaps. IBF Standards offers accredited programs to guide a financial practitioner from licensing examinations to professional certification. IBF Standards certifies financial practitioners at 3 levels. An IBF qualified individual is one who is equipped with a broad base of capabilities and foundational competencies to undertake new roles. An IBF advanced individual is one who has acquired applied knowledge and complex analytical skills for specialists or leadership functions. An IBF Fellow is an industry veteran who has demonstrated professional mastery and exemplifies thought leadership and commitment to industry. The IBF certification mark, a set of parallel elevation bars, symbolizes the close partnership between IBF and the industry. IBF certification is therefore an industry-endorsed mark of quality that recognizes individuals who exhibit professional excellence, integrity, and commitment to the industry. Be part of the IBF community of certified financial practitioners. Participate in continuing professional development programs. Avail yourself to learning resources to plan your career. There are also opportunities for mentoring and networking. IBF, the Asian standard of excellence for practitioners in finance. The Institute of Banking and Finance, or IBF, was established to foster and develop the professional competencies of the financial sector. IBF is dedicated to empowering practitioners with capabilities to support the growth of the Asian financial industry. It is the national accreditation and certification agency for financial sector competency. Developed by the industry for the industry, IBF Standards is a set of competency standards benchmarked to international best practices. IBF's vision is to be the Asian standard of excellence for practitioners in finance. IBF Standards covers 13 industry segments and offers a wide range of development roadmaps. IBF Standards offers accredited programs to guide a financial practitioner from licensing examinations to professional certification. IBF Standards certifies financial practitioners at 3 levels. An IBF qualified individual is one who is equipped with a broad base of capabilities and foundational competencies to undertake new roles. An IBF advanced individual is one who has acquired applied knowledge and complex analytical skills for specialists or leadership functions. An IBF Fellow is an industry veteran who has demonstrated professional mastery and exemplifies thought leadership and commitment to industry. The IBF certification mark, a set of parallel elevation bars, symbolizes the close partnership between IBF and the industry. IBF certification is therefore an industry-endorsed mark of quality that recognizes individuals who exhibit professional excellence, integrity, and commitment to the industry. Be part of the IBF community of certified financial practitioners. Participate in continuing professional development programs. Avail yourself to learning resources to plan your career. There are also opportunities for mentoring and networking. IBF, the Asian standard of excellence for practitioners in finance.
The digital world is ever-changing. With more than 20 years of experience in serving the investing public and the financial services industry, Cybercode has been providing financial training and information technology solutions for established clients. Cybercode is based in Singapore with 7 offices around the globe and continually expanding. Being ISO 27001 certified and having a proven reputation for service excellence, Cybercode endeavors to build long-term relationships with customers and business partners alike. Our services include, but not limited to, the following: investing public, to provide training programs to the public, such as investment and stock trading courses. Financial professionals, providing up-to-date training courses for the finance professionals, keeping them well informed with compliance, regulatory requirements, financial products, and best practices. Financial technology. We develop and provide information technology solutions and management services curated specifically for our clients' needs. Cybersecurity and data. We provide data, information, analytics, and cybersecurity services to your business, keeping your data safe. Since our inception, we have trained thousands of participants among the investing public, financial professionals, hundreds of B2B clients, and have continued to forge strong business partners. To find out more about what we do and how we can help you, contact us today. Cybercode is a leading financial training provider and a leading developer of information technology solutions and management services.
Hi, everyone. Good evening, ladies and gentlemen. Thank you for joining for this evening, Tuesday evening live webinars. How to live off dividends for retirement by our keynote speaker, Darren Chew, a financial service director from Phillip Wealth and also advisory department. Now, before I pass the mic over to Darren, let me just do a short intro of the company as well as Darren himself. Now, for those who joined early, you did see that actually we play two separate videos. One of the videos, the company Cybercode video, you get to know this video we just played about 2 minutes back, and of course one of the video we play Institute Banking of Finance, in short we call IBF. Now indeed Darren Chew is also one of the keynote trainer, also IBF accredited trainer, who providing one of the course called Lifetime Income Mastery course, which is he will share with you during the last part of the session. So it's very exciting for you to stay throughout the session to the end. He's going to share with you how you can benefit from this course. It's heavily subsidized by IBF for Citizen and PR, right? Now, of course, a little bit to share with this Darren himself. Now, basically, Darren started off as a financial advisors, easily more than 10 years back, and then off late about 3-4 years back. I think he is also one of the very unique individual with the other three members who form out a branch in one part of the Singapore, who are managing his own client as well as financial trading rep as well as financial advisors. And then under his arm, he had more than close to 30 over trading rep as well as this financial advisor under his care of, right? So of course, therefore, he have a very good reason why actually going to share with you, especially pertaining for today's topic, dividends and how to live off the dividends for retirement, right? So of course, throughout the whole session, you can always post a question into the Q&A, so Darren will answer along the way, right? So without much delay, I will cautiously pass the mic over to Darren, right? Okay, Darren, please.
Thank you, Andy. Okay, good evening, everybody. I'm Darren Chew here. Okay, but before I start, standard thing, disclaimer. Okay, what I share with you is for your information only. It does not constitute any financial advice. Please remember to do your own due diligence. Okay, on that. Okay, just a fast introduction of myself. Okay, my team actually operates the Investor Center at Jurong East. Actually, is located at Westgate Tower level 10. For those that are familiar with Jurong East, you know there's a Westgate Mall and there's also a Westgate Office Tower. Okay, I'm a trainer for IBF accredited program where I run this lifetime income mastery course, okay, which is 90% pre-funded by IBF. And for this year, there's only one more run left. Okay, after that, no more for this year. And next year, I think the funding will change to lower, definitely. Okay, because we are start to reopen up the economy already. Okay, I also have my YouTube channel, okay, which is called under my name, Darren Chew. If you want to know more about actually the more of the course content, actually what I share in the YouTube channel is mainly related to the course. Actually, it's more a support for graduate after the course. Okay, I also have a Facebook page. If you want to follow me and know about what other webinar I'll conduct in future, you can go and like this Facebook page, as I every month will conduct at least 1 to 2 webinars out of the Cybercode site. Okay, that means on my own. So you can follow my Facebook page. You want to be updated on the webinar I'm going to conduct, okay, in the future. Okay, this is a simple summary of me. 15 years in this industry, okay, and my team operate the Investor Center at Jurong East, and I lead a team of close to 30 stockbroker and financial advisor. Okay, so now let's get to today's topic proper. Okay, we are talking about dividend, we're talking about interest, we're talking about income for retirement. Okay, along the way, if you all have any question, please just type on the Q&A side. Don't wait until the end. That means along the way, just type question, but make sure it's just related to this topic. Please don't ask me what to buy tomorrow. Okay, so this is where you can just type there. Then I'll answer you along the way rather than wait until the end. Okay, so now let's get started. Okay, but before we get started, we just first thing we need to know is how much actually is really enough for retirement. Because when I talk about dividend income, then of course you need to know how much you really need. Okay, I would say that please don't follow what the newspaper say. Okay, the newspaper, there's always two camps for the newspaper. One will tell that you need very little money, and one will tell you need a lot of money. The one I tell you that if you need very little money will usually be the government. The one that tell you need a lot of money, you usually will be the insurance company. Okay, so both have their objective and intention behind or motivation behind to tell you that. Insurance company definitely want you to buy more insurance plan from them. So they keep on telling you need a lot. So it's never enough. Okay, so government tell you lesser because CPF like 2,000 per month only. Okay, so most important, you just need to know how much you need. Don't care about the research. Okay, the research is just for financial advisor to sell you things. Okay, I'm also financial advisor, so I understand what where they are coming from. Okay, so if you really want to know how much actually you need, so the very simple rule is we can use a something called a 4% rules. Okay, how does this 4% rule actually work? Okay, let's say that you spend $3,000 per month. Okay, so it is equal to 36,000 a year. Okay, so you just need to multiply by this figure called 25%. 25. It's not 25 years. Just the number is 25. Not 25 years. Okay, you get 900,000. So what does it mean? That means that if you were to spend 3,000 a month, as you currently have 900,000, you were able to retire, and this money were able to last you approximately 30 years. 30 years, 30 years. So this is how this 4% work. Okay, but there's a catch. This 900,000 need to grow. It cannot be sit in the PLCB bank earning 0.05%. It need to grow how much? It need to grow at the inflation rate, okay, plus 1 to 2%. So let's say you take our inflation rate as 2.5%, then maybe you need to grow around 4%. Okay, so this is what we mean by that. Okay, so it can last you about 30 years. But let's say you're only 50 years old now. That means you only last you about age 80. Okay, so this is how this rule works. But what happened? I said, Darren, I want to work the reverse can or not. As an engineer in the past, we always do reverse engineering to bring down the cost of all the spare parts rather than get from OEM, which they'll charge you very expensive price. Let's say you got $1 million. Let's say you got $1 million. 4% means that you can withdraw 40K per year. Okay, but this 40K per year is every year you withdraw plus inflation. So this is what we mean by that. But it can only last about 30 years, right? So if you want to last longer, then the very simple, just withdraw lesser, 3%. 3% means you withdraw 30K per year. Okay, then we're able to last you about 40 years. Well, it cannot last you forever. Okay, 40 years. So 40 years should be quite good enough for most people already. In many, you retire 55 years old, it will last you to 95 years old. Okay, unless you told me you want to retire age 40. So that's a separate thing on that. Okay. Okay. So that means that okay, so far there's a question. Next time you put question, don't mind put your name so that at least I can address you also. So at least I also know who am I talking to. Okay, it's true that money dividend paying unit trust cannot last long for retirement as they pay out from capital. So what can we do for the money income? Okay, this question, can you hold on that? Later I'll talk about unit trust, then I'll answer your question. Okay. When I talk about unit trust, I'll answer this question on that. Okay. Okay. That one is not really true. Okay, but I'll answer it when we go into unit trust to go into more detail on that. Okay, so this is how you work on that. Okay. And this is just an example of 4% rules. Okay, so now we are looking at on the withdrawal, right? So this is talk about cash flow. Another thing you need to set aside is called medical plans, medical insurance. Okay. Because what I talk about just now is living expenses, but there's medical bill you need to pay. Okay. That one we don't know when you fall sick, and you don't know what is your bill will be like. Okay, depend on you go government hospital, you go private hospital. That is depend on individual. So I always advocate that please get yourself medical insurance. If you are still healthy and never get, please just get. Okay. So it just depends on what you are looking at. You are looking at only B2 or C what? Cannot choose doctor, you don't mind, then your MediShield Life is good enough. Okay. MediShield Life is good enough. Okay. To take note, of course, it's not 100% cover, but it can cover up to 80 to 90% of bill. I think it's good enough for most people. The balance you can use your medicine to pay. So it's good enough. But you want to go private hospital, especially private hospital, and you want to choose any doctor or specialist, okay, then you need to buy an integrated shield plan. Okay, but besides buying an integrated shield plan, do know that this one costs money. Money is not for medicine, it's the cash portion, is the money that you need to pay. Okay, so how much you need to set aside? You want to look at anything longer from 60 to 85 years old, you need to set aside on average of 150,000 in cash, just to pay for the premium on the cash portion side. Okay, so this is on top of the money you set aside for retirement. So you do this longer until 90 years old, 95, of course, the amount will definitely go up, and definitely go up on the exponential graph. So this is something you just need to take note on how much you need on that. Okay, so let's move on. So now let me just show you a case study. Okay, then from there I can talk about the various asset class. Will be easier for you to understand. Okay, John is just like one of you. Okay, he's my client. Actually, he's a teacher, but he's a HOD. So he want to retire at 62. We use an inflation rate of 3%, and his money expenses is 3,000 per month. By the time of when he retires 62, it becomes 5,001. Why 5,001? Because of 3% inflation. So it grew to 5,000. And this is what he want. But we also need to look at what he have. Okay, so this is what he have. You can currently his OA and SA balance add together about 250,000. But after we do the projection, do a calculation at 62, his OA and SA balance left only 200,000. Okay, you wonder 44 years old, working for 18 years. Okay, currently got 250,000. By the time he 18 years old later, his CPF money get lesser. Okay, why is it lesser? There's two types that the money will go to. Okay, it's not really lesser in a way. One will go to the RA account, which definitely will not be counted here. Okay, we'll go to a retirement account where account with CPF life. The other one go to his housing loan. He's staying in a condo, need to pay installment every month. Okay, housing loan. So these are two parts, and thus CPF will only left 200,062. Okay, and in SIS, this is based on SIS, how much he put in. He put in SIS 15,300 for the next 18 years. So he put in about 140,000. Okay, 140,000. And he currently have a cash savings of 200,000. So this is what he have now. And how to grow his money, he will just put the money into all these various assets. Okay, and then he'll put the money into the various asset class. Okay, before we talk about what asset class, we talk about what are the products actually available for John, for him to grow his investment. So the first asset class we can look at is called fixed income. Okay, fixed income in short is called bonds. Okay, it's called bonds or perpetual securities. Okay, so this is the fixed income. Okay, the bonds that's available in the market. Okay, this is just a sample. Currently, if you want to look at bonds by itself, okay, the minimum investment amount of 250,000 or US dollar 200,000. There is more than 3,000, about 5,000 bonds available for investor to choose. But the catch is you must have this money. Okay, you must have this money. But I want to look at only on SGD basis, or SGD basis, then it's slightly less than 400 bonds for you to choose. Actually, still a lot. Singapore shares only 600 plus. Bonds, bond got 50% of the Singapore shares quantity. It's a lot. So this is an example. Let's say you want to buy bonds. These are just some example of the company. So from there you can see if you want to buy a bond. Let's just look at some example. Okay, let's look at Cathay Pacific. Okay, Cathay Pacific, because now can travel area. Okay, Cathay Pacific is an airline, it's a Hong Kong airline, but Singapore issue of bonds. Okay, and the bond is 3.56%. When you mature January 2023. So now is already November 2021, correct? So we left only about 14 months to go, correct? 14 months to go. So if you were to buy this Cathay Pacific midterm note financing bond, okay, and you hold it for 14 months, you get a guarantee of 3.56% return per year. It's not 14 months return, 12 months is 3.5. So you get more than that. It's per year. So you guarantee. So where can you find this type of 3% return, guarantee return? Only put 14 months. Actually, in the market don't have. So only the bond market will have. But what is your risk? Okay, your risk is Cathay Pacific go bankrupt. Okay, go bust. Okay, go bust, go bankrupt. Then your 250,000 will be 100% loss. Okay, so that is the risk. Okay, that is the risk. But some people say, okay, then in that case, I don't want to buy Cathay Pacific. I buy ARA asset management. I think this one's safer. Well, ARA asset management, this is the asset management company that manage the REITs. Okay, the AI, now they're going to bought over by ESR. Okay, which is here. So a lot of people say, like this got property backing, more safer. And it gives 3.6% return. But of course, it's under 2024 February. So it's longer. It's 2 year plus. Okay, 2 year plus. But 2 year plus actually quite short. And it can give you 3.6%, 7% guaranteed return per year. Not 2 year plus per year. So thus, if you have the money, you can buy this type of bonds. Okay, but you only need to make sure that you buy a correct one that don't go bust in that period. So this is a bond risk. And if you have money, you can actually even borrow, leverage, and another 250,000 to buy a second one. For example, let's say you buy this one, you take 250K, buy another one like ESR. Let's say we charge you interest at 3%. Let's say I talk a high side, charge you 3%. This is 3.84. You still make 0.84% return. And this 0.84% return is from a 250,000. So it's not small amount. Okay. And the interest definitely will not be small amount. Okay. And it's per year interest, per year return. And it's free money. That means you don't come up with the money and you just earn the interest. Okay. So this is called bond financing. So if you have money, actually you got a lot of avenue to grow money. And 0.84 plus 3.67 definitely will be more than 4% already. Okay, so this is what you can do it by bond investing. Okay, bond investing. You don't need to be an AI. A lot of people told me that I need to be an AI. You don't need to be an AI. As long as you got money, you can buy it. Okay, next. Then some of them say, Darren, is a bit too big a sum of money. I don't want to reach 250,000. Okay, for buy a bond later, it become another high flux. Then how? Okay, so then that's another option. Then you can buy what? Retail bond. Okay. Then you can buy retail bond. Okay, retail bond are bond listed in SGX, where as a retail investor, you can invest. And minimum investment amount is $1,000. So you got lesser risk. Okay, so the most you lose 1,000 only. And this is the currently retail bond in the market. Unfortunately, it only have so much. This is all. This is all the retail bond that's now in the market. I think got one new one called GSH. Okay, but that one I think I don't have much here yet. So this is the only one. So is it fair or not fair? That depends on how you look at it. You got money, you got options. You got less money, of course, you got less options. Okay, you got less option. And this is the current yield you are looking at. You don't want to buy retail bond. Okay. So of course, only these two got no dividend one. You can forget about that if you don't want dividend. But the rest is about 2.9, even 2.58 to about 5.9%. Okay, so this is what the retail investor you can look into it, but this one cannot leverage. Okay, so this one can leverage, so your choice will be limited. So then there's another term will be unit trust. I talk about later. Bond fund unit trust. Someone asked me that question. Okay, we'll answer that later. Okay, so this is what you can invest in. Okay, but you only worry about default. Let me just show you. This is the chart. Okay, this is based on January 20 to May 21. Because this is during the COVID period. During COVID period, now it's already October. Okay, this is number of bonds that have defaulted. And SGD actually got 2. Bond that are in SGD one defaulted got 2. But these two defaulted bond, one is a private limited company. Okay, one is a private limited company. It's not a listed company. The other one is a Hong Kong company. Come and issue Singapore to issue bond. Just like Cathay Pacific is also a Hong Kong company. Come to Singapore to issue bond. But this one is not Cathay Pacific. It's another company. So this is the two bond. And lucky that there's no Singapore listed company bond defaulted during this period. Okay. Some of you may say Hyflux. Hyflux is in 2019. Okay. So Hyflux defaulted in 2019. After Hyflux, I think we don't really have Singapore bond defaulted. Okay. Until now. Until now, we don't have. First REITs almost defaulted, but they raise money from investor rescue out first REIT. So if not, first REIT will default their bond also. Okay, so this is currently what is happening now. Okay, next, besides fixed income, some people say fixed income is too high risk for them, as you may lose 100% of the capital if you buy the wrong one. Okay, so what other thing you can buy? Stocks and shares. Stock and share is the most common thing that most people want to buy to get dividends. Okay, to get dividends, especially Singapore shares. Singapore share is very boring. Why boring? Because they only pay dividends. They don't have much capital upside. Unlike US share, China share, so exciting. Okay, but do think no, exciting means high chance you'll lose money because your emotion also go up and down. Okay, your mood also swing up and down. Okay, let's look at shares. Let's look at 4 Singapore counter as an illustration. Now you can, okay, but how to pick dividend shares? Okay, so I will share with you a very simple way for you to pick dividend shares. Okay, no need to go and look at financial report, all these things. You don't have the time. Okay, this is for you to shortlist shares. Okay, let's look at this example. There's 4 companies here, A, B, C, D. Okay, and when you want to buy a shares for dividend, you need to look at their track records. Okay, so this is 5 company A. So their past 5 years, this is current. This is current year. Okay, the latest year. Okay, so company A, you can see the dividend is 10.3 cents, 10.4 cents, 10.5 cents. So you can see it's going up. Then after it come down to 9.79 cents. Then after that, it what? Crash. Okay, crash. Okay, so this will tell you that their share price also what? Crash. Okay, this will indirectly. Why it crashed? Because COVID-19. So this company, you can see that it is badly affected by COVID. And with this, your current new buy is about 0.92%. This is based on October 27. Okay, when you buy that time, the yield will be 0.92%. Okay, next, company B, 28 cents, 30 cents, 30 cents, 30.5 cents, 32 cents. The dividend don't care about COVID. This is the COVID period. Okay, COVID period, depends on when your financial year closing. Don't care about COVID. Despite COVID, it go even higher, it go even stronger. The dividend yield is 3.28%. So you can see this share what? Benefit from COVID. So it doesn't mean everything is down due to COVID. Certain counter is benefit from COVID one. Certain counter get trashed very badly by COVID. So this 0.32. Okay, next we look at this company C. 20 cents, 16 cents, 16 cents, 9 cents, 5 cents. The dividend already start to drop even way before the COVID. So look like COVID, nothing to do with them. Okay, COVID come, it continue to drop. Anyway, it's already dropping. So COVID come, they just continue to drop. Okay, but the dividend yield is 4%. Okay, 4%. Okay, so company D, you look at it, the dividend is very constant. It never go up, it never come down. It look like nothing happened in the market, and it just on its own world. This company just look like it's on its own world, don't care about market. I every year just give you 15 cents. I don't care what happened to the market. And the dividend is 3.84%. Okay, 3.84%. Let me just do a simple thing. If you will have money, okay, you have money, which company would you buy? Okay, you can just start on the chat or Q&A. Which money would you buy? A, B, or C, or D? Okay, so this is how you're going to analyze a company, whether is it worth to buy for dividends or not. Okay, most people will just look at 4% buy. Okay, but do think that it is a dropping dividend, because a lot of people never see this part. They just see that, oh, now it's 4%, they will just buy. So do think that, look at dividend trend. Okay, dividend trend will never lie to you. Okay, so now let's move on to look at what actually these 4 companies is. Actually, these are real company. These are real company listed in Singapore and is famous company. I mean, the name you've definitely heard before one. Okay, the name you definitely heard before, and you will definitely know what they do one. Okay, let me talk about the fourth company. Let's talk about first company. Up, then crash due to COVID. Definitely is COVID related company. So this company is called ComfortDelGro. Okay, this company is called ComfortDelGro. Okay, so we can see the dividend crash means the share price also crash. It's all in line one. Okay, so the question is ComfortDelGro. A lot of people always think that ComfortDelGro is a taxi company. Okay, because ComfortDelGro, actually ComfortDelGro revenue is not from taxi. Maybe taxi contribute about 30% only. Okay, 70% is from where? Public transport. That is the bus and the rail. Okay, it is a bus and a rail. It's not taxi. Okay, it's public transport. And this public transport doesn't only talk about Singapore. It's talking about UK, Australia. These are the two main contributors also. Besides Singapore, these are two. Of course, they got other country one, but we're talking about these two main. So this is ComfortDelGro. Is a more of a public transport company rather than a taxi company. A lot of people just assume taxi company. Okay, so public transport company. So it's public transport. So we know that during this COVID period, not only Singapore got locked down, Australia also got locked down, UK also locked down. So where got people go and take bus, take MRT? Okay, so and of course taxi will be definitely affected. So that's why this share price crashed, and thus the dividend also crashed. Okay, the dividend also crashed. Now you need to look at it that ComfortDelGro before the COVID-19, they have been giving up dividend, increasing dividend all the while. So they are hit badly because of the COVID. So now we are in November now already. Okay, even now so I start with VTL, but VTL will take a long time lah. Okay, long time to slowly. Now it's people who want to go overseas. Singaporean are Thai in Singapore, they want to go overseas. So Singapore open up VTL lane with a Europe company, with US company. Yeah. Okay, so Singaporean will rush to go overseas. But then you look at the other way around. Are those European, are those American are rushing to come to Singapore or not? I don't think so. Okay, so we rush to go out, but they are not rushing to come in. Singapore is not a place that they want to come one. They must come one in their lifetime. But a lot of places in the world is a lot of Singaporeans want to go in their lifetime. Okay, so the VTL, although it's open up, but it's only open up for people to outflow to go and support overseas economy rather than people coming in to support Singapore economy currently. This is my view. So, but you look at longer term prospect, would you think the thing will pick up? If the thing will pick up, bus transport, MRT will pick up, will ComfortDelGro share price start to go up? Will ComfortDelGro earnings start to go up? If they'll start to go up, will their dividends start to recover back to the good old days? Okay, if your answer is yes, then is it now a good time to accumulate ComfortDelGro? Okay, so this is what I mean by that. If you buy now at $1.60 and they only pay what 0.01, I forgot what is the dividend area. Let me just look at it. Okay, they only pay you 0.0143 in dividend. Okay, and you only get 0.9%, right? Okay, and now it's about 160. If they will go to increase that dividend, let's say to 0.1. Okay, 0.014, right? So they just increase to 0.01. It's a 10%. Okay, what will be your dividend yield? And what would be the share price? Okay, so this is just something for you to go and think on that. Okay, if you wait until you go back to 290, then you start to look at it. Then there's another, and then there's completely another issue area. So this is something for you to look on to this aspect, but it must, but the risk is ComfortDelGro go bust. Okay, but what is the probability of it going bust? So this one something to look at it. Okay, number two, the dividend never drop, only go up despite of COVID. Who is this company? This company is called SGX. Okay, SGX have benefit from COVID-19. Why? Work from home. I'm a stockbroker. For those not aware, I'm a stockbroker from Philips Securities. I'm also a financial advisor from Philips Securities. What do? I sell insurance. I manage unit trust portfolio. I manage stocks portfolio for for people. So during last year's circuit breaker period, I received many phone calls from clients that open account many years ago, never use, and then they started to call me, Darren, I now work from home, got time to look at stock market already. Last time go office work, no time to look. So I now want to know my account number. I want to know how to buy shares. Okay, so indirectly, SGX is a beneficiary of the COVID-19. Okay, is a beneficiary, and thus SGX share price have went up, and they make more money, and thus their dividend have increased. Okay, but of course, this is one part. Despite that, SGX still face challenge. You can see they still face some challenge, but this is nothing to do with the COVID. Nothing to do with COVID. It's due to competition aspect. Okay, like MSCI have leave SGX here, but SGX have fight back and go up. And now there's another news. MSCI have started to be active in Hong Kong, and thus SGX is affected badly, and thus it come down. But do you think SGX will fight back and go long term? Okay, and SGX have defined themselves, they are going to be a dividend growing companies. Okay, they officially say they are going to be a dividend growing company. Okay, and they start to take on more debt. Okay, a company need to take more debt to grow. Okay, so this is what SGX will be. So in that case, with that current price will be a good entry price. That will depend on how we want to look at it. Okay, if you feel that the dividend will be continue to grow in the long term, and they are a profitable company, it just make more or less only. So would now be a more attractive for you if you want to look for a dividend growing company. Is SGX a good candidate, and current price is a good price to buy? So this is something you can look into it in more detail. Okay, so next I'm going to talk another company. The dividend have been dropping year on year even before COVID, but it give you 4% yield now. It's the highest among the four. Okay, what company is that? This company is called what? StarHub. Okay, this company is called StarHub. Okay, I think no need mention, everyone know what StarHub do. And why is StarHub fit now? Before COVID, it already pumped all the way down already. So imagine you buy 5 years ago, you buy 342. Now it's 127. You lost 50%. And your dividend keep on drop. Your dividend is from 20 cents drop to 5 cents. The dividend drop even more than 50%. Okay, the dividend drop, I think 70%. Okay, so this is StarHub. And do you think that are they going to go up? Are the dividend going to go up? Okay, I think this one everyone should roughly have some idea on that. Okay, so do you think this company have hope now? Okay, if you think have hope of them, of course you may want to consider. But I think I don't know hope, right? Then of course you can forget about it. Okay, you can move on to other companies. So this is on StarHub. Okay, the last company is the dividend have never dropped, but never increased. It is consistent for the past 5 years. This company is called ST Engineering. Okay, and you actually look at the past 5 year chart, it is quite boring. It's quite boring. Why boring? People go up, people come down. There's some excitement there, but this one is it like what they are moving. Of course, COVID make the drop wider only, but it is like what? Sideways one. Quite boring, sideways one. But the dividend also quite boring. They give 15 cents, don't care market up and down. Okay, so sometimes investment need to be boring. Investment if investment is exciting, then maybe you'll lose money. So this is something that's a boring company that don't give you much capital appreciation, but also didn't give you much losses. Okay, in terms of volatility, I think they're the best one among all the four, right? Okay, so this is a boring thing. And what business they do? ST Engineering got only two parts. One is called commercial, and one is called what? Defense. Okay, one is called defense, and one is called commercials. Commercial is mainly on aerospace. Okay, of course they got now another new structure, but that one I think the revenue not big enough. Aerospace. Okay, so this is defense. We know that every country got defense budget one, like Singapore. Okay, and they are so-called the unwritten rule. ST Engineering are the unwritten rule, is the defense contractor for MINDEF. And if MINDEF every year increase budget, and I think MINDEF budget will definitely increase every year. Okay, so who is the beneficiary from that budget? Okay, I think everyone no need to mention name, right? Okay, you all know that ST Engineering will definitely benefit from that. And ST Engineering don't only do defense for Singapore. They are quite sophisticated. They can build tanks. They can build better ships. Okay, and they don't sell it only to Singapore. They sell it overseas. They sell it globally. Okay, to other countries. Okay, so this defense indirectly protect them during this COVID period, because commercial business will definitely drop due to COVID. We can't travel, so all the business drop, but the defense business increase. This in the way stabilize the company on their P&L. So one side drop, but the other side go up. So in the end, balance off. But in good market condition, definitely this side will go up, this side will go up. Then that will be even better for everyone. So this is ST Engineering. Give you a boring dividends, 15 cents perpetually. The share price also quite boring. Okay, but when you talk about retirement income, I think you may want to look for something that's boring. Okay, to be part of your portfolio. So this is the 4 company. Okay, that pay. So this is how we can do analyze which company to buy for dividends. It's just by looking at the dividend trend. Okay, and just look at their current status now, and you know that which one you can buy, which one you should not buy. Okay, so don't even need to look at the financial ratio, look at the analyst report, all this. This is a fast way for you to filter off companies. Then after that, you can zoom into more detailed analysis. Okay, so this is one part. So the next part is to further that, make sure that you make the right choice. We will need to look in one more part. It's called the payout ratios. Okay, what is actually a payout ratios? Maybe I just want to illustrate some more. Okay, let's say a company earn $1. We call earning per share. Earn $1. He pay you dividend 50 cents. This is called dividend per share. So this is called DPS. So I earn $1, I pay 50 cents. So my payout ratios will be how much? 50%. Okay, so this is what we mean by payout ratio. So I pay out 50%. Okay, but let's say I earn $1 earning per share. Can I pay you dividend at 120? Okay, this is something like you earn an income of $5,000 a month, but you spend $6,000 a month. So you earn 5,000, your paycheck is 5,000, but you spend 6,000. Then you need to think, where is this 1,000 come from? Same thing, and this company earn $1, they pay 120. Then where is this excess of 20 cents come from? Okay, money cannot be dropped from the skies, right? You'll be from what? Their capital, from their reserve. Okay, from the reserve. And this one, the payout ratio will be 120%. So the next question you need to ask is this sustainable or not? Can they last or not? Just like you earn 5,000 and spend 6,000, how long can you last? Okay, unless you got a gold mine behind you lah. Okay, one day, even you got a gold mine behind you, one day it will still finish on. Okay, one day will finish on. Same thing for company. So one day they finish, they cannot sustain. What will happen? What can they do? They what? Cut dividend, right? So when they cut dividend, what happened to the share price? The share price will crash. Okay, so this is something you need to. So a payout ratio too high is also called a red flag that you should avoid when buying this company. Okay, so now let's look at the 4 company. Let's look at the 4 company. Let's look at their payout ratio for the 4 company. Okay, first let's look at ComfortDelGro. So before COVID, 10.3, 70%. They increase their dividend, but actually they also increase their payout ratio. So this is something new. Take note. Increase dividend, increase payout ratio. So this tells you that their earnings may not actually increase. It's just that they pay you more dividend only. Okay, so this is something you need to take note. But after that, their dividend increase, their payout ratio maintain. This show you that what they have managed to increase their revenue. But after that, their dividend drop, payout ratio increase. Okay, this show you what revenue or profit actually have dropped. So this is directly tell you the sign. So it's just like reading story. Okay, now after that, then the crash. This one I think we know it's COVID. Okay, so but this is a track record in the past. This is COVID, so they are constantly paying about 70 to 80% the type of payout ratios. So they keep 20% to grow. Currently, they only have 50%, and this is so much. So when they were to grow, and ComfortDelGro had mentioned that they will try to pay at least 50% of their income out as dividend whenever they make money. Okay, they will tell at least 50%. And this is something called a dividend paying policy. They have their policy, okay, to try to pay out. So imagine if they were to increase, okay, then if they were to maintain just a payout ratio, your dividend will increase, right? Your yield will definitely go up, right? Okay, and in future, when they go back to this thing and they increase their payout ratio to this, will dividend continue to grow? Okay, so this is one thing about ComfortDelGro. Okay, next, let's look at SGX. 28 cents, 88%. 30 cent payout ratio increased by 1%, but dividend increased by a lot of percent. 30 cent maintain dividend, payout ratio drop. This show what? Revenue go up. Increase some more, payout ratio drop further. Make even more money. This shows that the SGX make even more money by paying more dividends, but they also make more money. And this one they increase by 32%. Of course, the payout ratio go up also because they have increased quite a fair bit. So practically, you can see that SGX, the payout ratio is about 80%. Okay, around 80%. So this is something to think. As long as revenue able to increase, they're able to continue to give you good dividends. Okay, let's look at StarHub. 20 cents, 102%. As I mentioned, this is something called red flag. Can they sustain now? Cannot sustain. Thus cut dividend. Okay, before that, they also 20 cents. Okay, cut dividend already, still 103%. Means this indirect means what? Profit drop. This indirect side profit drop, right? Profit drop, they still die want to pay you the next year. They still die want to pay you 16 cents some more. And the profit drop further some more. And thus the payout ratio become 147.3%. So definitely it's not sustainable. So cutting dividend is expected. And that's why they cut. Cut to 79%, still cannot cut further to 58%. Okay, so were they able going forward to maintain this? I don't know. But they are telling that this is their track record. They try to give you things that's too high and cannot sustain. So this is what you need to take note. When see company that pay you something that's a bit unreasonable, just be careful and try not to touch that type of company. Okay, let's look at ST Engineering. Dividend very constant, but payout ratio is always in the range of about 90%. Okay, so this is something you need to take note. ST Engineering, practically they pay out close at least around 90% of their income and give it to you, and they keep very little money themselves. Although they never exceed 100%, they keep very little money among themselves. Why this one 81% is that they got very good revenues, very good profit. Okay, but they still maintain that. Okay, so we know that ST Engineering will give you a stable dividend, stable income, and they can pay out so high a payout ratio because the company is big. The company is big. Okay, so the company is big. So if they keep 10% of the money for them to continue to grow, it's still good enough for them to continue to grow. And actually, in fact, they are growing. But okay, in fact, they are still growing, but they're not growing very fast. Of course, they are big, too big to grow too fast also. So this is one thing you just need to take note of. They try to maintain 15 cents. So that means that their revenue must maintain, their profit must maintain. If one year they got a drastic drop in income, then this may need to cut. Okay, because they got no buffer to move it. They pay 90%. So this is a danger of ST Engineering. Okay, but we hope that this thing will not happen due to their nature of business. The defense side is definitely there. Aerospace is promising, and the aerospace is not in Singapore, mainly in the US. Okay, and even can support the US military, the US fighter jet. Okay, so we definitely hope that I also definitely hope that you are able to maintain that, but it also have an increasing dividend policy. So indirectly, you are buying this ST Engineering, although it's stable dividend, but do take note your dividend is dropping. Okay, it's dropping. Why? Dropping due to inflation. Okay, so this is something you need to take note. Your dividend actually dropped due to inflation. This one is hedged against inflation. This one is hedged against inflation. Okay, but this one is affected by COVID. Okay, So this is something you need to think note. Of course, this one is worse than hedging again, is dropping. So this is how you can select the stocks just by purely looking at the dividends, at the payout ratio, and just you need to just understand what the business do, and you from there you see that whether can they last for the next 5 to 10 years. Okay, it is a very easy way for you to pick stocks. Okay, based on that, on this aspect. Okay, next. The next one we're going to talk about is called what? Shares. Okay, the next one we're going to talk about is called shares. Okay, so what is next one we're going to talk about is called REITs. Okay, so REITs is an asset class. Okay, that a lot of people like. Okay, this is REITs. Okay, so these are total about 38 REITs listed in SGX. Okay, do think on REITs and business trust is very different thing. What I talk about is called REITs. Business trust is a separate thing. What is business trust? NetLink is a business trust. Capital Infrastructure Trust is a business trust. Asia Pay TV, Ascender India Trust, Dartin Retail Trust, they are all business trusts. So we need to segregate a business trust and the REITs. Okay, so this is REITs. And REITs, a lot of people say they are looking to buy dividends. Okay, but my take is when you look for REITs, right? Okay, please don't focus on dividends too much. Okay, let me just talk about this. Okay, even SGS will tell you that buy REITs, why good? Because REITs got a good dividend, 6.1% over STI, only 3.5 government bond. But they are not comparing an apple to an apple. They ask you to compare REITs to STI, compared to government bond. Of course, it's different thing. Okay, because the intention is to brainwash you that tell you that buying REITs is about buying dividends. Okay, but to me is a wrong concept. Okay, the wrong concept. Okay, on that. Okay, and this is something I tell you that also REITs also got different sector. And please don't just follow this thing that blindly. Yeah. Okay, for example, office REIT, they tell you 7.3%. Wow, office REIT look very good. Hospitality so low. So should you buy office REITs or should you buy hospitality REITs? Okay, it is completely different. Do think office REIT, you say that got 6 office REIT here. Okay, you got 6 office REIT. So you need to understand what are these 6 office REITs. For example, 3 are US office REITs. 1 is Europe. 1 is UK. And 1 is SG focus. It's not even pure SG, it's SG focus. Main part is to SG. So it is completely different place where the office is located. So this average 7.3% actually is meaningless one. It's meaningless. It don't give you any meaning at all. Okay. Why? A US REIT dividend yield compared to Europe, UK, and Singapore, of course, is definitely different. So how can I make together and tell you that this is average thing? Okay, so please don't blindly for office REIT is 7.3 is good to buy. It's not that way. And SG focus REIT, the dividend yield definitely have to be lower compared of a REIT that property is overseas. Okay, so this is something you need to think of. You buy a REIT that is that their business generally focusing on property in Singapore, their dividend yield have to be lower compared to a REIT that their property is focusing on overseas. Why is that so? Because you are taking more risk for buying overseas property. Okay, taking more risk for buying for overseas property. One thing is currency risk. One thing is political risk. Okay, and one thing is you also don't know what the country well also. So these are risks. So this is something to take note. Just so please don't blindly buy a REIT because the yield is high. Okay, the yield is high. And same thing boils out to why hospitality is the yield is low. Because hotel is not operating. Okay, hotel is not operating, and there's even REITs that are losing money. Okay, there's a REITs that even lose money, can't even pay out dividends because all the hotels shut down. So in that case, of course, the dividend yield will be lower. Okay, because the share price will crash, the dividend also cut a lot. Okay, so please don't just build on this yield table to decide what REITs to buy. Okay, what REITs to buy on that. And also that when talk about dividend, maybe I just share with you how you calculate a dividend yield. A yield of a dividend, okay, is based on percentage. It's always based on 2 parts. a dividend divided by what? Price. Okay, a dividend divided by price. So what dividend we're talking about? We're talking about the past dividends because it's already declared. You need to have dividend to calculate, right? And the price is talking about current. So in order for your dividend yield to go up, what need to happen? The REITs must announce bad news. Announce bad news means what? Drop in dividend. Drop in dividend. When something bad news comes, they say drop in dividend, what will happen to share price? Price always move faster than dividend one. Okay, just like you want to buy a shares for dividend, like CD that time you buy, after XD, what happened? The share price will plunge, right? And you see the share price will drop more than the dividend you collected one. Okay, that's Singapore stocks. Okay, the dividend say that pay you 10 cents. After XD you collected 10 cents and the share price may drop 12 cents. Okay, so this is usually how the market works. So please don't buy share just to chase for the dividends also. Okay, dividend coming, you go and buy, the price will drop more, you see will drop more than the dividend you take. So in then you lose money. Okay, so this is how a dividend yield, but how to make a dividend yield drop? Okay, the dividend must increase. Okay, the risk announce, oh, I'm going to increase my dividend. So this is good news, right? So people go and run in to buy the REITs. So the share price will go up. And thus the yield drop. Okay. So what does this moral authority tell you that? So a REIT that pay too high a dividend is sometimes means that they may have problems. The REIT is having problem. A REIT that pay too low or dividend, you see means that the REIT is performing. So it's the reverse. It's performing. So this is something to take note. So please don't buy a REIT just for looking at the yield. Actually, the yield don't really have much meaning. You buy a REIT, you should focus on something called total returns. What do I mean total returns? Okay, total return means capital gain plus cap dividend. Okay, so let me just show you this. This is from 4th of October, so it's pretty recent, and this is published by SGX, so data cannot be wrong. Okay, so we can look at 12.1%. Is this high dividend yield? But look at what counter is called. It's called first REITs. I think everyone know what happened to first REITs. So do you want to buy a 12.1% REITs? Do you know how much capital loss you lost? I think the capital loss is more than 12.1%. For those that are holding first REIT, you should know what I mean. Okay, your capital loss is definitely more than 12.1%. Okay, so they give. So what's the meaning of getting 12.1% dividend yield? Same thing. Let's look at this. 3% dividend yield. A lot of people come in, Darren, 3% dividend don't make sense and so low. I'm buying a REIT. But look at what is this REIT. It is called Parkway Life. For those that buy Parkway Life, you should know that the dividend never dropped since IPO. The dividend is only go up, never drop before. And I will feel that going forward, the dividend should continue to go up also, because built based on the structure of the REITs. So if you buy something that you know that the dividend will go up every year, what will be the share price? Will definitely go up, right? And you see the share price will go up faster than the dividend growth rate, which is why the dividend yield is low. So this is what we mean by that. Okay, but this is just one example. Please don't just look at, oh, this one, then what about this one, dividend low? Because hospitality trust is barely affected. Thus, everything get cut, so everything drop lah. Okay, so this is, so don't just blindly looking at you. You don't give you much conclusion. You should look at more of the total return. You should look at the dividend trend, same as why you look at stocks. The dividend trend in the past has the dividend been going up or not? Okay, and this is why you should focus on rather than looking at you by per se. Okay, so this is what you need to think. For example, let's talk about Suntec REITs. Well, 5.8%, that's it good? It is good, right? But do you know that if you were to invest Suntec REITs for 5 years, that means you buy Suntec REITs 5 years ago and hold until today, the return you get, the total return, I talk about total return. Total return means what? Capital gain or loss plus dividend. is worse than you putting money on CPF OA account. Okay, let me put in CPF OA account, you make more than 2.5%. You make 2.5%. That means they give you a return that's worse than 2.5 CPF OA. Okay, or on par with CPF OA. But you face the market shock, swing up and down, up and down. So please forget about the yield per se when looking at risk. You look at the complete picture of the risk and focus on the dividend trend rather than the dividend yield. Okay, so this is how you should look at risk. When you focus on the risk that dividend only go up their share price will almost guarantee will go up. Okay, well, when focus on the risk that they pay very high dividend yield high chance that their share price actually coming down here one. Okay, so this is something you just need to take note on and come to risk investing. Okay, next, unit trust. Why unit trust got this space when it comes to investing is unit trust is the only asset class that are able to pay you dividend monthly. Okay, only asset class that is risk-based asset class that are able to pay dividend monthly. And there's close to 2,000 unit trusts for retail investor to choose. But it's got the dividend paying one, maybe 300-400 unit trusts. It's good enough already. 300-400 unit trusts for you to pay dividend. But the rule, same thing. This is example. Okay, please don't focus. Okay, this is based on end September one. End September one is also, please don't focus on the dividend yield. Okay, please don't focus on the dividend yield. When something that's too good to be true, just step back and think, how come so good? 9% dividend. Okay, 9% dividend. How did the fund manager able to give me 9% dividend? Okay, let me show you. And actually, let's look at top 3 one. The top 3 one, the NAV will give you some clue already. Some clue already. This is $6.31. This $7.07. This $4.28. Okay, a unit trust will usually launch at $1 or $10. Based on the high dividend yield, I will able to guess that their launch price of this unit trust most likely is $10. Most likely is $10. So what does it mean? That means $10 dropped to $6.31. How much capital loss you lost? 30% or more. I get 9.1%, but I lost capital loss of 30% over the years. This one was 4.28. That means I lost more than 50% of my capital just to enjoy 9% dividend. Okay, so this is back to just now the question asked. Okay, is it? Let me go back to the question. Is it true that money dividend paying unit trust cannot last for retirement as they pay out capital? It show what can we do with the money income. Okay, so this is maybe, so at the same time, I just answer that question. Okay, so you have to understand how unit trust work. How unit trust work is an international practice on how unit trust work. So when someone tell you that they're able to pay 8% dividends, okay, then you need to look at what they buy. They either buy stocks or they buy bonds. These are only 2 asset classes you buy. Okay, risk also consider stocks. So can you find a stocks that give you 8% dividend in the market? Maybe yes, but then it's how many? Not a lot, right? And the stocks that can even pay you 8% one, you see very high risk one, or penny stocks are going to collapse already. Because based on the dividend yield over cash cover. Same thing, can you find a bond that pay you 8% one? Maybe yes, high yield. Okay, I think talk about high yield, a lot of people scared. Okay, talk about high yield. So this is what we talk about. Okay, when talk about. So the question is, usually they will not able to get 8% one. So the dividend they collected when they invest is maybe they only get 5%. They only get 5%. Then where are they going to get the balance 3%? That balance 3% is mainly to capital gain. Capital gain. That means the stock price rally Like the risk, the unit trust may buy what? Apple, may buy Microsoft. Wow, rally like nobody business last year, right? They make capital gain, so they just sell a little bit, got 3%, right? Then they can give you 8%. That's how your dividend comes from. So your dividend doesn't mean that it really from dividend you collected. Okay, it can be from capital gain of the underlying asset they buy. Okay, so this is one thing. Next is what happens when there's a market downturn. This is capital loss, right? Market downturn, where got gain one. Okay, for most of the counter. And dividend will definitely cut, right? Let's say only 4%, right? And this one 0. But 8% where to come from? Where to find the other 4% they give you? Okay, this is what I call return of capital. What do you mean by return of capital? Return of capital means I sell off your investment and liquidate your investment. I take the cash and pay to you and tell you that this is your dividend. Okay. Okay. A lot of people say, is this Ponzi scheme? This is not Ponzi scheme. Ponzi scheme is that you give me money, I give it to another person. Okay. This is called Ponzi scheme because your money. But this is you give me the money, I invest the money. Then after I didn't tell you, I go and sell off your shares. Then take out the money, I give it to you. I tell you this is your dividends. Okay, but we are telling you that actually I sell off your shares just to give you that money because I can't generate the dividend that I tell you that it will generate. So this is called return on capital. So by the return on capital, you see is on the market downturn when the market start to drop and they start to sell off your investment, and you see they sell at a lower price, right? And this will resulted in your net asset value keep on dropping. Okay, keep on dropping. Okay, so this is what unit trust can done. Okay, but do think just be careful. Do think not all unit trust do this way lah. Luckily, it's not all unit trust fund manager do this. Some unit trust fund manager have the assets company have the mandate. They will never do this. It's even in their unwritten rule, they will never practice this type of practice. Okay, on that. But some of them will just want to honor the dividend, so they do that lah. Okay, so this is something you need to take note on that. Okay, so it just dries out to you need to choose carefully on the unit trust you're buying. So when something the yield is too high, just walk away lah. Okay, just walk away. Okay, what is the realistic dividend? You are buying a bond fund, a realistic dividend, okay, a realistic dividend about 4 to 5%. It is realistic. Okay, but do take note, no capital upside. Okay, so this is what you need to take note. A lot of people say bond safe, yeah. But this is the one. If the bond fund able to pay 4 to 5% dividend per year, please don't expect to have capital gain. It may have some minor capital loss due to market downturn. Okay, because it can't generate one. It can't generate that type of dividend plus capital gain. No way. Because there's okay. So you want to have a 4 to 5% dividend with capital gain, right? Okay. Then you need to buy balance fund, okay, or equity fund. Okay, then you will have capital gain plus a 4 to 5% dividend. So this is something you need to take note on that. Okay, when for those that want to buy a dividend income from unit trust for dividend per se, okay, you want to have capital gain and plus 4 to 5% dividend, then you need to focus on these two types of fund. You don't go and buy a bond fund. You buy a bond fund, you must have that in mind that I'm not going to have capital gain. Okay, but you buy something that gives you 7%, 8%, this one, you must prepare for possible of capital loss. Okay, on that, possible. I cannot say not all fund will be like that, but higher chance of capital loss will be there, okay, over the long-term period. Because it's not sustainable. If they were to buy high yield bond fund like Asia high yield bond fund, they can pay 7 or 8%. Yes, they want the bond is the dividend is really real one, but you face default risk. Just like now, all the Asia high yield bond fund get whacked because of China Evergrande or China property stocks going default. Okay, so we also need to think when when come to investment. So this is one of the things that you need to think of when come to risk unit trust investment aspect. Okay, so this is how a unit trust dividend will pay. They can pay from the dividend they collected, they can pay for capital gain, or they can return from your capital. Okay, that depends how is it being structured. And you cannot say you don't know because it's printed in the fact sheet. Okay, here this example say positive distribution yield doesn't imply positive return. Here tell you already, I give you 7% dividend yield doesn't mean you make positive return. You may lose 10%. Okay, so it is indirectly tell you that your dividend may be from the capital. Okay, they didn't tell upfront, they are indirectly tell you that. Okay, next look at another statement. Okay. Historical payment may comprise of distributed income or capital. So this is what I call return from capital or both. For the detail, please refer to our website. Our website didn't tell you much. The very clear also. It's a big gray one. Okay, so this is something you need to take note. You need to scrutinize the fact sheet to see. Some of the fact sheet don't print this type of word one. If they don't print that word, high chance they may don't have this practice. They may have this, don't have this practice. But some of the fact sheet they print this word doesn't mean they will have this practice. They just put it there standby in case they cannot deliver. They at least got something to pay out to you. Okay. So this is what we talk about on unit trust. Okay, so these are the 4 asset class that we are able to generate at least 4% return over long term. Okay, 4% we talk about minimum return over long term so that you can have a retirement, have a dividend income for life. Okay, and next is savings and retirement plan. What do you mean by savings and retirement plan? Savings and retirement plan are from the insurance company, and many there are different category. One can be pay you lump sum, one can pay you a fixed payout, okay, which is guarantee, yeah. Which guarantee, yeah. Of course, this is non-guarantee lah. One can pay inflated hedge return over time, which is also guarantee, yeah. Okay, wow. When insurance company tell you it's guaranteed, it's really guarantee, yeah. Okay, this is one thing you need to know. When what is printed on the insurance company is guaranteed, is definitely guaranteed. Now a lot of people ask me, Darren, what happens if the insurance company go bust? If insurance company go bust, MAS will guarantee you 100,000 of surrender value or 500,000 of death benefits. If the MAS guarantee you higher than the banks, the bank they only guarantee you 75K. Insurance company MAS they have to guarantee you 100K on surrender value, 500K on death benefit. This show indirectly tell you what insurance company is safer than the banks. It's so much safer than the bank. A lot of people thought that bank is safer than bank. The insurance company, no, insurance company is safer than bank. I mean, if the banks were to go collapse, the insurance company will still be there. Okay, it will still be there. But if the insurance company go collapse, high chance the bank will go on already. Okay, so this is what we mean by risk on that. Okay, so no need to worry about insurance cannot deliver. As long as they tell you guaranteed, you will definitely be guaranteed. We are talking about insurance company that have an office in Singapore and is approved by MAS one. You go overseas to buy insurance plan, overseas insurance company, that one I cannot guarantee that, because that one I don't know how is that the other country do. Okay, especially developing country. But Singapore context, you see not an issue at all. Okay, and there's this one, that's most popular one is something like CPF Life. It gives you 2 portions. The bottom is called guaranteed, the top part is non-guaranteed. Just like our CPF Life will also tell you that there is a range they'll pay you. There's a lower range and higher range. Okay, because CPF Life actually is also insurance plan. We just I don't know who is the insurance company behind the CPF Life. Okay, so they also invest and they got top 10, top tier, and top and bottom that range. So this is another form of retirement plan. So the question is, when you look for something that's guaranteed, the return cannot be high lah. The return cannot be too high. Okay, so when it comes to buying retirement plan, there is no risk, but it is guaranteed. Okay, and can be guaranteed for life. Okay, guaranteed for life. Okay, I just show you this is an example. I just use John to illustrate. Because John 44 years old. If you were to buy a retirement plan, I even tell you company name. Okay, do take note, this is not a recommendation of this plan. Okay, this is just to show you an illustration. This may not be the best plan in the market. Because I can generate multiple insurance company quotation, I just find that this plan is easy to illustrate. So I just generate this plan. Okay, so you pay for 5 years. Accumulate under he's 62, then you pay him out for 20 years. So it's from 62 pay under John 81 years old. So how much he paid per year? 54,000 premium. So total premium paid times 5, in total he paid about 270,000 in premium. Okay, 270,000. But he get a guaranteed income of 1,500 per month. Per month. So total for the next 20, how much you collected? You collect 260,000. So that's what I mean, guarantee you don't lose money one. You put in 270, you guarantee 360. Okay, guarantee. Is the yield return very high? Not high, 0.99. But do think that this is guaranteed. It is just something like a lot of people put money in the bank. Okay, today I just go and talk to one client because the client give me some money to buy certain plans. She told me that she put this 100,000 in the banks for 20 years already. Okay, so in the end, she only earned a few $1,000s of interest over the 20 years. So she finally wake up, but it is 66, 67 years old already. She put 20 years, 100,000 in the bank. Okay, and thus if I want to make him better return now. So this will definitely be better return than they put money in the bank. Okay, over the long term period. Okay, of course you put in fixed D, it may be higher, but don't think of fixed D only that is a cap, right? This is guaranteed, and there is something called non-guaranteed portion. We can be so your total return. This is a non-guaranteed amount. It can be a range of 246,000 to 464,000. It is always a range. So, but at least you can see at 270, you can make. We take a lower tier one. You can grow to 602. That means it's more than 100%. 224% payout. That means I paid 270, I can get 600,000 back. The yield is about 2.87. It is similar to what your CPF OA, right? So it is still pretty decent. Okay, one thing is no risk. Okay, so this is one part. A lot of people say 2.87 too low. Yes, but this is no risk. That's why I talk about you buy some tech risk, right? Put 5 years. Okay, put 10 years, 15 years, maybe it just give you 3%, 4% return. But you have so much risk involved. Okay, of course, the highest tier you can get 4%. But don't focus too much on the highest tier. The insurance company may deliver. If they deliver, it take it as a bonus. It cannot deliver, then say you already know that you will not deliver. Okay, but the lower tier one usually is possible to deliver because the insurance company doesn't make 3% return. Okay, if they can't even make 3% return, I think something may be wrong with the insurance company. Okay, so this is what we call about a retirement plan. Okay, a retirement plan. It gives you a peace of mind, but of course you need to compensate for the lower return. Okay, there's no free lunch. A lot of people say, Darren, I want no risk, high return. If there is a product that's no risk, high return, high chance is a scam. High chance will be a scam. Okay, because if it's the real thing, I think nobody will be working already. Everyone will just at home shake leg because no risk, high return. Okay, so why work so hard? Okay, so definitely there's no free lunch in the market. So this is the 4 things. So the next question is, which one is the best? Okay, which one is the best? Okay, the conclusion is there's no best products in the market. Okay, it is more of what suit you best. Okay, and this is what you can look at that. Okay, when it comes to stocks and REITs, the return definitely is the highest potential return, but the risk also high. And you need to have effort in. Okay, I just share with you a simple way to do that, but it's still an effort. It's still effort. ETF return is high. Okay, risk also high, but effort is moderate. Okay, but the best part of an ETF is their dividend yield is quite low one. Unit trust, effort, potential return is high, effort is high, effort is also moderate, but they can pay you dividend monthly. Bond, exclude the high yield bond, it is moderate, moderate, moderate. Annuity and retirement plan, return is potential return is low, the risk is lowest. I cannot put no risk. I can only put low risk, but your effort is 0. You buy already and forget about it. Other people do the job for you. So which one you like, that depend on how much effort you want to put in. Okay, how much effort do you want to put in? Okay, there's no such thing that give you the highest return but 0 effort. Okay, don't really have such thing in the market. Okay, so and the next question, when you want to look at the asset, also you need to look at life expectancy. What do you mean by life expectancy? Now let's talk about life expectancy. What does life expectancy means? Means that 85. let's just use 85 as a mean. 85, what does mean 85? That means 85 years old. Let's just look at all of you here. Half of you will leave the world already when I reach 85, but the other half will still be around. So if you are the person that leave the world already, I think you don't bother about whether got money or not. But if you are got person that is still around after this age, right? Then you need to make sure that you have money and health. Okay, but if you got no health, make sure you got medical insurance. Okay, medical insurance. If not, your money all go to pay to the doctor. Okay, all go pay. But the next thing is this money. How are you going to manage it? Do you think that you still can, at 85 years old, 86 years old, you still can manage your stock portfolio, your risk portfolio as well as now? So this is something you need to think of. Do you think you can make better decision now at 85 years old than now? I think may not be. My mom is around this age already. And actually she start to have dementia already. Okay. So this is something to think of. So she can't manage it. Okay. She can't manage money already. Okay. So this is something you need to think of on that. So do you want to have something that will give you income, but depend on how you want to make it? Okay. Thus, I always advocate that when you want to build a income portfolio for dividend for retirement, always try to approach using a basket approach. Don't just talk about one asset class. Okay. Sometimes you need to forego certain returns just to balance out your risk. Sometimes you need to take more higher risk if your portfolio all on the conservative side, just to make sure that you get some alpha and get better return. So this is what I call a basket approach on that. Okay, let me go back to, and this is ultimately the portfolio you will want to have is you have something that able to give you a paycheck that's guarantee you an income. And this, we are very fortunate that we have this CPF line there to give us some income. But let's say, but CPF line now is only can pay about 2K per month. But let's say you need 3K per month. Then you may need to find something to fill up the gap, like retirement plan or CPF balance. Okay. But then the balance, you can use investment to grow, we call the play check for this aspect. Okay. Now let's look at John. Back to John case study. Remember when we start off the webinar, we talk about John. Okay, so this is John again, just in case for those that miss it. This is John. He want to plan for retirement at 62. And this is inflation rate, his expenses, and this is what he have. So how he allocate his investment? Okay, how he allocate investment now? Okay, do think of this is a live example. This is not a fake example. Okay. Let me just answer this question first before I continue, John. How the charges being paid for the monthly charges? I noticed they are selling certain amount of unit trust to pay for the money charges. Then does it mean that they are using paying capital to pay money? Are you okay, from the question I look for me now, are you getting someone to manage your unit trust for you first? Okay, because this type of money charges, you notice is only unless you get someone to manage for you, then you can able to see that. If not, you should not able to see that, or unless you buy unit trust in some platform that charge you a platform fees. Okay, unless you charge a platform fee. So I need to understand where, because most likely this type of charge is more likely is you are getting someone to manage for you. Okay, if not, you're not able to see it from your statement one. Okay, so I need to know more detail on that. Well, I also manage client investment portfolio for that. I'm managing client portfolio for 15 years already. Okay. Okay. Oh, okay. Yes, actually, it's a Manulife platform. Okay, that one is a very unique thing. You're buying an investment link plan. So it's completely different thing. It's not it's not the fund manager are paying the capital, you're paying the agent, the Manulife some money. Okay, on that. So that you are paying some for, and maybe for insurance charges. Okay, so it's not really a unit trust investment. Actually, you're buying an investment link plan, not the unit trust I'm talking about. Okay, the unit trust you're talking about buying, you should not see all those charges. Yeah, it is an investment link plan. Okay, so I will not want to talk about investment plan here. Investment plan is just not for everyone. It's not for everyone. Okay, it's not for everyone. You must know what you're going in, and usually they come with high costs. Okay, it come with high charges. Okay, can. Okay, now let's move on to John case. Okay, so this is John case. Okay, so how you allocate his money? So you can see this is how you allocate money. He got 200,000 cash. He put 60,000 into a unit trust portfolio. I only put a 4% return now. I just be conservative because 4% is easy to achieve for a unit trust portfolio. Of course, you want 8-9% will be tougher. Then 40,000 into a low risk product. This one is like Singapore savings bond. Okay, last time Singapore savings got 2% one, but this is not current case. This is a few years ago case. Okay, he's still I managed for him on that. Okay, then this is 100,000 where he put in the stocks, include risk that we only projected 6% return. Okay, and he got a plan that he matured at 62, now paying 1,004 per year, and he got a retirement plan that pay 5 years, 1 year pay $10,000. Of the SIS money, he split into 2 portions. SIS he can invest, and he can also buy a retirement plan. He do both, okay, to get the best of both things, and also to mitigate the risk. So this is ultimately what he have. Okay, so at 62, what actually happened? Okay, he surrendered his insurance policy where he think that he noted it at 62 years old when cash value he is 100,000, and his CPF life will pay him 2,500 per month. And his SIS plan will kick in both the retirement plan and the investment plan will come in. So do think that he need 5.1K per month. But here is already 5.8K. So at the start here have more than enough already. Okay, here have more than enough, but do think the SIS last 10 years after no more. Okay, and then the stocks dividend, then the interest dividend. Okay, and the retirement plan. A lot of people want to buy retirement plan. They say, Darren, I want to buy a retirement plan that cash out at 55, 60, 65. Then for John case, is also thinking of the same thing that most people think. Then I just throw the question back to John. John, you at 62 years old, you have so much money here already. Yeah. Do you still want this one to come out? Well, actually, you don't need that, right? Okay. And everyone know that for retirement plan, you will to push longer, right? Your return is higher. Right? So why should you put it earlier? Since you don't need the money, why don't push it back? So you push it back to age 70. And this is where he have now. Okay, this is where his plan is now. Okay, and this is his retirement portfolio. Okay, on this. And this is how his retirement portfolio is classified. The insurance plan is called promise-based retirement plan. The CPF life is called promise-based. Just now remember I thought portfolio got 2 parts, risk-based and promise-based. His SIS plan got promise-based, also got risk-based. His stocks risk definitely is a risk-based. His unit trust definitely is a risk-based. The retirement plan is a promise-based, and the CPF money and cash is a promise-based. So this is his portfolio, and he can able to last him until 90 over years old. Okay, until 90 over years old. Okay, then it deplete the whole thing. Okay, so this is the income, how to build a multi-asset portfolio. This is an example of that. But every one of you is different. Some of you will have more risk-based because you are more savvy, more knowledgeable. Some of you will have more promise-based because you are less investment savvy and you don't want to take too much risk. Okay, everyone is different, so nobody is will have exactly the same portfolio, but the concept will be a multi-asset portfolio in this aspect. Okay, and anyone got any other question before I continue? Okay, if have okay, so this is voice out to the course actually I conduct called Lifetime Income Mastery. Actually is to teach how to build multi-asset portfolio using all those asset class that I mentioned during this webinar. Okay, and this is the last session for this year. Okay, after that I'll take a break, and the next session definitely will not unlikely to be in first quarter of next year because my second child will be born in January, so I definitely am not going to conduct course during the first few months of the year. Okay, so the next one may be April or end mid-March, I don't know yet. Okay, so this will be the last session for this year. Okay, and it will be fully conducted by me. And how does this course run? This course will run with 10 modules, or 10 modules, 3 parts. So the first part will be more towards personal finance. The second part will talk about analysis of various asset class. The third part will be how to put everything together. Okay, so the first module will be talk about managing your finance. Before I talk about investment, you must know how to manage your investment, your personal finance. Okay, so we'll talk about your personal finance, how to make cash flow and net worth statement, and how can you increase your return by not taking additional risk. This is what I always emphasize. How can you increase your return by not taking additional risk? Just like I shared that this morning, I go and talk to this client. She got 100,000 put in the bank for 20 years. I just asked him to put into another product that is capital guaranteed, everything guaranteed, and give her 1.6% return per year for 3 years. Okay, so this return, I think it will be better than I think the total return he collected is more than 20 years of the return he put in the banks. Okay, this is what I call how to improve your return without taking additional risk. Okay, on that aspect. Okay, next we talk about insurance. Okay, insurance will never make you rich. This is why I always emphasize. But you need insurance, as I mentioned, that you definitely need medical insurance. If not, all your investment will gone to the doctor or to hospital. Okay, but we also don't want you to be a slave to insurance premium. So this course will talk about how could you optimize the insurance plan and how to find the most cost-effective plan in the market, and what are the plans you should look out for and what are the plans you should avoid. Okay, so that you were able to have more money to plan for your retirements and grow your money. Okay, and of course we'll talk about CPF. How can you maximize your CPF? How to do CPF shielding? Okay, SA shielding, OA shielding, and how can you cash out your OA money first before you cash out SA money? The legal way. What I thought is a legal way. A lot of people, because for those that are aware that you want to take out your money from your CPF after 55, you have to cash out SA first, then you can cash out OA. But there's a way that you can cash out this one first before you cash out this one. Okay, but there's certain risks you need to take. Okay, go in with an open eye. After that, we talk about SRS. Okay, SRS is not just talking about contribution, talking about what can you invest in. It's also talking about how should you withdraw it to minimize tax. Okay, how do you withdraw it to minimize tax? So this is another part, I need to take note of that. Okay, after you finish the module part 1, we'll talk about part 2. Part 2 is analysis of the various asset class. Okay, do take note, this is a hands-on class. Okay, it is not a theory class. What my hands-on class? That means you really need to keep your hand dirty. You really need to analyze things in the class, and you must submit in the class. Okay, one example is you need to do bond analysis. Okay, do bond analysis. And we're not talking about bonds in the past. We're not asking you to analyze high flux, why high flux fear. But that one is already over already. No need to talk already. Okay, you go on, I cry on the account, come home, so the money will never come back to you. We only look at what is the bond now in the market. Analyze that. Can buy or cannot buy. Can buy tomorrow, you can go and buy already. Okay, so this is what we mean by want to do that, a more practical approach. So we're in the class, we analyze at least 2 bonds. At least 2 bonds. Then after that, you can use this method to go and analyze the rest of the bond when you want to buy a bond. Okay, so this is on the bond side. And next, we'll talk about stocks. But stocks, we can only focus on value stocks, Singapore dividend stocks in the class, because we don't have much time to cover other stocks. Okay, other stocks I'll cover only to our graduate, that our client in a money revision class. Okay, so we analyze at least 3 Singapore dividend stocks at current price and see whether is it worthwhile to be in your watch list, or maybe is it opportunity to buy immediately. Okay, but after the session, I'll give a list of stocks that you can put in your watch list to monitor a better time to entry and to put in the retirement portfolio. Next, we'll talk about REITs. Okay, we'll analyze at least 3 REITs in a course. And of course, after that, I'll give you a list of REITs and I'll give you the selection criteria and how to analyze it. And you can just duplicate the method to analyze the rest of the REITs on your own. Okay. And of course, unit trust, there's close to 2,000 unit trusts. They got equity fund, they got balance fund, they got bond fund. So we will analyze all the 3 types of unit trust, equity, bonds, or balance fund during a class, so that you can repeat this method and go and analyze the other unit trust that you want to buy to build your retirement income. Okay, and the module 9, we'll talk about retirement plans. We'll actually do a comparison of the current retirement plan and savings plan in the market to let you know actually what is currently in the market and what should you look out for and what type of thing that you should look out for when you want to buy a retirement and savings plan, because we give you life plan. We don't give you a plan that's 10 years ago. We give you a plan that today, tomorrow you want to buy, this is the plan in the market, so that you know what is the return and how to do a comparison between plan from different insurance company. So this is on the module 9. Okay, and the last part will be module 10, is to build everything together so that you build a multi-asset portfolio. So we'll give you live case study. Okay, you will get case study, try to mirror people that is real, you can feel that is real like you, and you use that example to plan a multi-asset retirement portfolio for that person. Then after that, you can use the same method to plan for yourself. Okay, so this is how the course will work around that. And how to do it, you need to know how to use the Microsoft Excel. Okay, so this is something you need to take note. You must know how to surf the internet. So that's first part to attend this course. If you are someone that don't know how to surf the internet, please do attend this course, because I can't help you. I can't hold your mouse because I can't even see your screen. I can't hold your mouse to ask you to navigate here, navigate there. That one is beyond my control. And also you must know how to use Microsoft Excel. I'm not going to teach you how to use Excel during the course because I expect you to know how to use Excel. But we're not asking you to do programming for Excel. You now have to know how to do the basic Excel function. Insert row, delete row, how to save as, okay, how to delete, how to do plus and minus. Okay, so this is a simple thing. You need to take note of that. Okay, if not, please don't sign up for this course. Okay, if not, you'll be very stressful because you don't know how to navigate the internet. You don't know how to use the Excel spreadsheet. Okay, and after the course, I only have Telegram group for drawing scan. After the course, I got this YouTube channel. Actually, this YouTube channel I divided into various sections. Okay, where it's a more of a follow-up that you can actually go and look at it. Okay, more like a revision. Of course, it's not the course content, but some of them actually is the course content inside this YouTube channel. For that, attended the course is more like a revision. Okay, and I also do analysis there. Like currently, I got 11 REITs analysis there. Singapore, and I've done 2 stocks analysis there also. Different stock. You can go and look at it, and you actually can also ask me questions there, and that's how you can connect with me. And of course, I got this Facebook page that I will post my future webinar. Okay, that I'm going to conduct. Yeah, and you can also continue to go there. It's more like revision. Get in touch with me also after the course. Okay, so this is a 90% pre-funded course by IBF. Okay, and if you're Singaporean, you can also use a 10% of skill future credit to pay for it, the balance, indirectly like free for most people. Okay, you don't come out any single cent. Okay, and do take note, this 90% pre-fund will change from next year. And this is the only slot left for this year. So if you want to sign up this year, if not next year, you may have the pre-funding will drop for a certain group of people. So this is something that I want to talk about that. So okay, so this will be my last slide. So anyone got any other question you want to ask, you can type a chat box. Okay, if not, Andy, are you there?
Hello, yes, Adrian. So Darren, I'm here. Just
yes,
a minute.
yeah.
Can you see me? Yeah. Okay, cool. Thank you very much, Darren. We have a very thankful Darren to have a busy guy like him who are able to come out to fork out his time here to join in for this 2-hour session. Now, indeed, those who are joining in, you consider a very fortunate individual because you are going to grab this special prize that which is also the last intake for the year of 2021. Now, these are the date. Basically, right now, this is the course, Lifetime Income Mastery course. You never find in the market where give you the whole holistic of the investment portfolio, right? And therefore, that's the reason why Darren did give emphasis to all that you want to join in for this Lifetime Income Mastery course. First thing first, you got to get yourself. You need to be basically how to use. You need to know how to use the Excel, Microsoft Excel, because this course, Lifetime Income Mastery course, right? It's a very interactive, and it's very, I would say, it's like a case study, a scenario based, and you learn it, and then you can apply it even after you graduate from the Lifetime Income Mastery course. You can apply it into your own self investment journal. So that's the reason why Darren keep emphasis that you need to have a base knowledge of the Excel, right? Of course, if you don't have any knowledge, you don't know how to navigate the, go to search to SGF websites and so forth, then I think that would be very challenging for Darren. Then basically they may not be suitable for you for this course. So individual, let's say if you're viewing in, you're joining in for this session. Now today we also do it live in the YouTube individual. Those who join in via the YouTube, likewise, you can also scan the QR code, do register the course. Now, these are the total 4 dates available. Which you can see on the slide, there is about 2 days session on the 11 and 18 November, 7 p.m. to 10:30 p.m. And then followed by 2 more days on the 13th and 20th November. That is on the Saturday, 9 a.m. to 4:30 p.m., right? So what I can do here is I will just, while waiting for some question coming in, what I can do here currently, I will just do a simulation of some of the registration that maybe and if any of you have some query, you can actually go into that and then share with you. So I just, to share on my side, going to share with you, how are you going to use it, during the registration. Now, I believe right now, all of you here should be able to see this slide. Okay, let me just pull this one back here again. Okay, you can see this slide, right? I presume all of you can see slide. Let me just check one more time again. Yes, all of you can see this slide. Okay, now this is the slide for the course registration slide. In short, they call LIM, stand for Lifetime Income Mastery, course registration form 2021. So when you click on the link that's sent in the chat, or even scan the QR code, and you just tap into this, and then you just select the only date that we have currently. And please help me to fill up your all your particulars and details as possible, because this is an online class, but however, we will still provide the course note to be delivered to your mailing address. So there's a reason your mailing address, your postal code is very important. We have to ensure that you key in the correct unit address and all those necessary information. So basically, you join for this course, your declaration should be under the self-paying individual, right? And then just move downwards, then and until the portion, you can see there's a payment method. Now there's a total 5 different payment methods for your selection. So the very first one, I think just now Darren did mention, if you're joining as Singapore citizen and you still have your SkillsFuture credit, a very good piece of news to just share with you here. You can use your SkillsFuture credit to pay the $160.50, which is the unfunded fee, the 10%, using your SkillsFuture credit, only for Singapore citizen above 25 years old. I will do a simulation later to show to you, so using my personal account. Now, for those individuals who join in, you are a permanent resident. Yes, you still entitled for the IPF 90% subsidy as long as you're residing in Singapore. Then you can select for PayLah, PayNow, and also Visa payment. Online payment, we accept Visa or MasterCard payment, right? Now, as you can see, there's a last payment called check payment. Now, we all knew that now it's basically work from home is still a default mode. So even for ourselves, like today, even I run my webinar session, I also run it at home. I work from home. So check payment at this juncture, we strongly we will not recommend the course participant, the sign up to using the check payment, because the reason very simple, because you issue a check, you may post up, maybe sometime we may not be back to office, maybe sometime I may back to office 1-2 days, then maybe you may misplace of the check. So the best way is still PayLah, PayNow, and MasterCard payment, right? I think PayLah and PayNow are most common nowadays, right? And of course, if you are Singapore citizen, yes, of course, you can use a SkillsFuture credit to that. So once you select any of them, you can see you can move the review button. They say you confirm you're using on the SkillsFuture, then you click and then you just move down and then just click on submit. So once you submit the right, there will be a course registration form sent to your email, and it will be basically like we call it like a complete course registration form. And that form you serve as a supporting document for individual who like to use SkillsFuture credit to make payment. Now I'm going to do a simulation using my personal account to show you my SkillsFuture account. Let's say individual, if you're using SkillsFuture, you just stay on the first column, the first review button, SkillsFuture credit, and then you just click on here, and that will the page itself, it will link you to the page of the SkillsFuture page, directly connect to the Lifetime Income Mastery course. As you can see, our course, Lifetime Income Mastery course, is already listed in the SkillsFuture portal, right? So what you can do is just click on the login, and we all knew that when SkillsFuture involved, you require to use your SingPass. So what I can do here, I will always use your SingPass. I do a scanning in. So once you scan in, right, and then yeah, I'm using my face recognition, right? So within about 10 seconds, you can see my login page will appear, right? And my credit, my name, you see, as you can see, my name and my credit is available. I have a full credit I have not been used, so I have a total 1,005, right? For individual, we are below 40, you only have 500. Yeah, for above 40, you have additional $1,000 more. As you can see, lifetime income mastery is all here. And the code, the SkillsFuture code, the company cyber code, and then it will capture a full cost fee before GST. So what you can do here is just click on the claim SkillsFuture credit, right? So once you click on that, and then that will actually go to a next page, right? As you can see here, yep, over here, let me see. Yeah, it's over lifetime income mastery show here. So what you can do, you click on the right blue button, right? And then that will go to a next page. On next page, basically, what you can do here, as you can see, you're going to start off the session is on the 11th of November. Basically, you just key in on the page of this is 11th of November. Let me just check one more time. Is it 11? Okay, just double check again. Okay, yes. Sorry, it's not. It should be. Okay, let me see again. The date is, yes, correct, 11. So 11, you always key in the first course start date 11, and then you move downwards, right? And you can see here, there's a fee payable by you. You have to key in 160.50. Okay, likewise for the amount of credit to claim, 160.50. So these two columns, you key in the same dollar value of 160.5, excluding the dollar signs, is already listed there already. So this is the portion that you need to take note. Remember, as I mentioned to all of you, if you decided using a SkillsFuture to make payment, make sure that you also submit the form, and then you have to keep track on your email. There will be a cost registration form sent to your email in a PDF file format, and you save that file into your local drive or in your desktop. So once you've done that already, you go to SkillsFuture, you tap into upload, then you can go and search where you save your file, and then you just open up. When you open up, then you automatically it will upload into this square box here, right? So once you've done that, you can see the cost detail is all here, and then you just click on the term and condition, and then just press on the submit button. So once you press on submit button, in the next 10 seconds, there will be a next page appear of pending ID. There's a 10-digit pending ID. So that means that actually SkillsFuture portal already captured your submission of this lifetime income mastery cost of the payment of $160.50, and you put under ledger, which means you see your let's say if your full fee you have not been used, your 1,005, you put under ledger, you minus off say 160.5. When the class start on the 11th of November, and then SkillsFuture, you debit the $160.50. So SkillsFuture, basically, they will only debit your credit only when the class starts. When before the class start, you will not do that. But of course, they put under ledger. So this is basically, we call it for individual who are using SkillsFuture, Singapore citizen, you are using SkillsFuture credit. Then this is the step that actually just go through with you. You can do that, right? Now, individual, if you say today, lock out first. If today, if you're joining in here and then you are not, you're on the PR, of course, what you can do here, same thing, you are using your this PayLah, PayNow, or online payment for payment. I mean for the payment that what we mentioned earlier on, right? Okay, so you can see there's a QR code provided. So this will be the last intake for the year, 18th of November, the first 2 days on the Thursday evening, 7 p.m. to 10:30 p.m. And then followed by the next 2 days on the Saturdays, there's a full day session on the 13th as well as the 20th November, Saturday. And this timing start from 9 a.m. and around 4:30 p.m., right? And over here, this is what we call the QR code is all provided for you. Scan the QR code, or if not, you just mouse over your mouse to the chat. I just send a hyperlink. There's a HTTPS hyperlink. Just double click on the hyperlink. It will link you to the registration page, which is I just show you earlier on. And please go and reserve a seat, fill up your detail, as well as to make the 10% of the cost fee. Remember, when you register a seat, you also got to make a payment of $160.50 with GST. Right? It's a SkillsFuture credit eligible. Now, over here, you can see here, 90% of the cost fee, which is $1,044.50, 1444.5. This fee is already pre-funded for you. What does that mean? Basically, that you only pay the unfunded fee, the 10% of which. So remember, I think just now Darren did mention, right? Next year onwards, right? We already get the concrete information from IBF. Next year, starting from Jan 1st, 2022, the IBF funding will be reduced down to 80%. So which means the trainee or the course participant will sign up for the course, the lifetime income mastery course, right? Our course still running on next year. But however, you could pay 20% of this fee. So that means you have to pay $321. You just times 2 of the fee that you pay right now, right? So 160.5, you times 2 is about $321 with GST. So which means next year onwards, right? Starting from 1st Jan 2022, your payable fee for you to join in for lifetime income mastery course, the same course, the same duration, but however, you could pay additional $160.50 with GST. So we will suggest that you, like what Darren mentioned, if you are able to make it for this 4 day, since it's before the December, right? So you can make arrangement to join in, to register a seat and make payment from that, right? So the other thing also just share with you here, you can see right below the SkillsFuture, there is also show proof of the NTUC member eligible for UTAP funding, right? Now, individual, if today, if you join in the course, this preview session and happen to be you also a NTUC Live member, as in your membership is still live, right? And then, of course, or you'll be eligible under this UTAP funding for our course. So our Lifetime Income Mastery course is also listed in the NTUC portal for the UTAP funding. So how it works? So you could pay the full fee, this full fee of $160.50 with GST via PayLah, PayNow, online payment to Cybercode. When you complete the course within 60 days, you could claim 50% of this fee, which is $80.25 from NTUC. So if today you join in, you are a citizen and you have your SkillsFuture credit. So obviously, SkillsFuture credit is the most viable because why? You can use the full of the $160.50 with GST to pay using a SkillsFuture to pay this cost fee. Unlike the NTC funding, you only can claim back 50%, and moreover, you got to pay upfront the 160.5 to Cybercode first, then you claim back from NTUC after course completion and 60-day after course completion. Though for NTUC, they also set the rules. So you remember you got to claim within 60 days, within 2 months. 2 months after the course completion, you could claim. If you more than 60 days, you claim, then basically it may not be valid already. Okay. Now, individual, you may see, Andy, how come below there's another company sponsor and how come the fee payable is different, right? Now, remember I mentioned earlier on to all of you when I show you the illustration slide, 99.97% of the individual who join in for our Lifetime Income Mastery course, they are fall under the self-sponsored scheme, which means that you're learning the course for yourself, for your improvement of knowledge for yourself, right? Now, there are people who say that, Andy, I don't want to pay 160.5, use my own wallet or payment to pay for it. I want my company to pay, can or not? So obviously can. So of course, this fee you see is different. You could pay $255 with GST to Cybercode, and then you claim back from your company after the course completion. But the key point is, bear in mind, the key point is you have to align, or rather to say that you have to inform your company training department to allow you to join in for this Lifetime Income Mastery course, because we come across there are people who assume that the company they approved for them to go to attend for this course. At the end of the day, the company, the training department don't not agree for them to pay the employee to join for the course, and at the end, the employee got to fork up his own money to pay this $255. At the end, he had to pay additional, fork out almost $100 more, which is $90 more to pay for this course fee instead of $160.50, right? Okay, so that is actually to spell clearly to you, this course itself, Lifetime Income Mastery course, is more for the self-sponsored individual. Okay, so I believe I explained quite clearly on the administrative side for the registration, and then the key point is, the key takeaway to just share with you is the last intake for the year. Now, I would like to just do a summarize that what are you going to take, what are you going to learn from this Lifetime Income Mastery course? I think mainly Darren Chiu already went through with you the total 10 modules, right? Correct. Today, the dividends is one of the topics, is one of the modules that you're going to learn from Lifetime Income Mastery course. So what you're going to learn, the key point, you're learning a multi-asset portfolio, stocks, bonds, REITs, unit trust, insurance, right? And of course, today just talking about dividends is also one of them as well, right? So you're learning a portfolio management and the risk management skill, right? So like what Darren mentioned, you will invest, you do invest everything in the whole basket, right? You will invest in the segregate out of your investment portfolio, right? You're also learning about the insurance investment. And the interesting part is this course, Lifetime Income Mastery course, you have a case study when you before the start of the course, right? We will send you a case study there will be a case study like personal finance and retirement planning for you to try it on, right? So this is very good. When you do a case study, you can register in your mind, you can actually apply it into your or self-investment portfolio even after you graduate from the lifetime income mastery course. So these are the five, I think more than 5 points of the key takeaway from this lifetime income mastery course, right? Okay, so if any of you do have any other more further question, yes, please feel free to raise a question, to pose a question in the Q&A, right? I think I'm here to assist you, to provide you the answer, right? Anything pertaining to the administrative, how to go about it. And also, let me just add it on, it's the IBF accredited courses. So I think Darren did highlight to all of you. Basically, you have to make sure there's a couple of things you need to take note, right? When you go through this course of lifetime income mastery course, as long as the IBF accreditation course, first thing first, we have to ensure your computer PC or your desktop, you have a PC webcam. Just like you can see Darren for the last 2 hours, you can see me right now. You need to have your PC webcam ready in your PC webcam, right? Or if not, if you're using a desktop, you have to make sure that you buy additional PC webcam to be attached to your desktop, right? It's a requirement because before they start the class, we got to take a screenshot, we got to take a recording, and then we need to send out to the IBF in order for you to save the fee of 90%. So imagine you are only paying 10%. So the remaining 90%, 1,444.50 is already pre-funded by IBF for you, for Singapore citizens and Singapore permanent residents who are residing in Singapore. So this is actually very, very good deal to just share with you on that. Now, and then the other thing is like I think Darren did mention, you also have to have some form of knowledge and your IT knowledge. You need to have Excel. You need to have Excel in your PC laptop or in your desktop, because during the class, you need that Excel knowledge for you to go through that assessment. There's a couple of assessment you need to do it, and then the assessment you need to be submit during the class via online submission, right? And there is also a small components of the e-learning module. We call it like a LMS, the learning management system, e-learning. Via the e-learning is an MCQ manner. That will be about almost 10% of the e-learning you go through. Need all the course participants to be complete during the last day of the course, right? So these are the things that actually is a prerequisite. We also have to ensure the course participant, you're okay with that. If an individual, if you join the course, you have a challenge to switch on your webcam, you don't want the people to see your face, then unfortunately this course, lifetime income mastery course, may not be suitable for you. Or even individual who join in today, you don't know how to navigate laptop, you totally don't know how to surf internet. I'm so sorry, there may not be a right course for you as well, because